Hello and welcome to Money Control. You've tuned into IPO Wrap, and I'm your host, Nickey Mirchandani. Again, a week where a lot of action perhaps taking place in primary markets, more from the mainboard side rather than the SME side, at least when it comes to the issues which open up for bidding. The coming week would be an interesting one. Two mainboard IPOs will be hitting the primary markets, Juniper Hotels and GPT Healthcare. These are the two names that perhaps you'd be hearing a lot next week. Also, Vibhor Steel Tubes, an IPO which has got a stellar response with more than 20 times subscription, will be also up for listing. The shares are allotted for retail shares. Essentially, these were oversubscribed by 26 times, and the category reserved for HNIs was oversubscribed by 28 times. The quota for qualified institutional buyers was overbought 3.42 times. In terms of SME board, Zenith Drugs will be opening for bidding to raise 41 odd crore. 6 companies will be listed on SME platforms, including the names of Wise Travel India, Esconet Technologies, Interiors, and more. Atmoscare, Thai Casting, and other names also, which make it to the list out there. Juniper overall, let's gravitate back to the main board issue, where Juniper is looking to raise around 1,800 crore from the primary markets, will open up for bidding between Feb 21st to Feb 23rd. But we have Prashanth Tapse right now who's joining us to talk more about these IPOs. First up, of course, Prashanth, hello there, and thank you so much for joining us. Of course, he's from Mehta Equities. I'm going to start off by asking you about what do you make out of the upcoming two IPOs. One is a healthcare company, which is relatively smaller size IPO, 600 crore. But let's discuss Juniper first, which is an 1,800 odd crore offering.
Yes, it was great to see Juniper Hotel IPO. It's a 8,000 crore market cap IPO, which is to open next week. For me, it looks like a great brand coming to raise money from the market. That is Hyatt, which is a luxury hotel business model in India. And wherein the Sharaf family, which is managing these assets in India, is also a great hotel management from last almost 2-3 decades in India. With respect to valuations again, due to the numbers are in losses, I think we cannot be sure of doing it on a PE valuations. But if you do it on price to book value and even EBITDA by room valuations, this looks better right now. But again, with the high debt in the books, I think it's a risky subject for long term.
Sure. Prashant, I'm also trying to figure out what are the key downsides to this IPO, and also talk about the valuation. You've spoken about, of course, we can't really talk about the PE because it's a loss-making entity, but what are the downsides or the challenges that you think this IPO is looking at?
So challenges for me would be on the industry side again because of the high capital intensive industry, wherein coming up with a new luxury brand in any metros would be a very costly affair for any brands in India right now. Would be a biggest risk for more expansion going forward. Second would be, I think, for Jennifer, the non-exclusivity agreement with Hyatt would also be a very negative point for me because going forward, any other partners of Hyatt in India can come up with new hotels in the same city, which would be very negative for Hyatt location demand and supply. So these two are very much concerned for me as well as the cyclical industry again. Every second, third, and fourth quarter would be a better quarter for a hotel industry, and the first quarter and second quarter would be a weaker part. So I think a cyclical industry will also be a negative concern for me for hotel industries.
Okay, how about the valuations, the debt to EBITDA? Sorry, I lost you in between, but if you could just reiterate the valuation bit, the debt to EBITDA seems to be a little higher, 32
Yes,
times compares to that of 27 to 28 times of other industries. Talk more about the valuation space.
I think on the valuation side, yes, due to the high debt right now, which is almost more than 20 to 2,300 crores in the books, which is eating up a lot of cash flows of the businesses, which is killing this company a lot from last 2 to 3 years. But industry-wise, yes, this is the common factor. But the way they are growing faster in terms of their revenues and adding more rooms, this would be a helpful factor for them. Again, the main objective of the IPO is to retire the debt. Almost 1,500 crores of the money which will be raised from markets will be going to retire the debt, which will help them to improve their balance sheet going forward. Right now, yes, the EV by EBITDA rooms are on the better side. On a price to book value, again, they are on the cheaper side. On the debt, on the equity side, yes, they are on the higher side. It is on the concern, but obviously the objective of the IPO is going to help them to make balance sheet better.
Yeah, that's exactly also some of the worry, right? It is the finance cost which essentially is weighing down on the profits of the company so much so that the last 3 years have been, the company has registered in losses. The first 6 months of the present year it's recorded in losses. What do you really like within this company?
I think the really liking would be the brand and the location, the strategic location where they are located right now. All the seven assets which are managing Mumbai, Delhi, Ahmedabad, and all, they are very much strategically located near the airport, near the business hubs. That would be the great thing. And second thing would be the luxury brand Hyatt. Hyatt brings in a lot of credibility in the market where they are into right now. So these two things help them a lot to bring their top line growth. But yes, again, the efficiency comes the main factor of any hospitality or a hotel sector comes into their cost is really high right now. The employee cost is really high now. For Juniper, again, the debt would be the highest cost. But going forward, I think they are going to save almost 12 crores of the financing cost every month, which will come up almost 140 crores for financial year next financial year, which will be directly going down to the PAT. So next financial year would be the better number to look at for this company.
Okay, they've actually given the guidance. We've spoken to the management in this week where they're expecting a turnaround to take place by the first half of FY25, of course, and debt would be reduced to an extent of 1,500 odd crores for Juniper. But let's actually bring in five highlights for you. A, Hyatt has a strategic stake solely in Juniper Hotels, the only hotel development firm within India. Second, the company enjoys highest EBITDA per room and RevPAR as compared to that of its peers. Third, the company has been loss making for the last 3 years and first 6 months of the present financial year. The net debt to equity at 5.5 times is the highest as compared to the peers, also because it's a asset heavy model. And the company will be repaying its debt of around 1,500 odd crore through IPO proceeds, leaving with a debt of around in the range of around 7 to 800 odd crore. But Prashant, I'm going to come to you on the second one. GPT Healthcare initial public offering, which will be the 13th offer of this year, which will open for bidding on Feb 22nd, giving exit to PE firm Banyan Tree. The IPO is a fresh issue of shares worth around only 40 odd crore. Another part of it is it's a 600 crore issue essentially. Out of that, 540 is OFS, and remaining, or rather 560 is OFS, and 40 crore is just the fresh issue which will be used to retire debt. Prashant, what do you like about this one?
See, I like the industry because that's a very defensive sector in India right now, the hospitality, hospital sector and the healthcare sector. They are highly focused in Kolkata. The strategic location of the each and every hospital is the main point which I am liking in this hospital company. They are located in a high dense area in Kolkata, wherein a lot of high population is there, and that will be giving them huge flow of patients and the growth in terms of all the treatments they're going to give. Second, again, the management bandwidth is really strong. All the top managements are from the doctor and highest experienced management team. So that will give them the second point, which I like this company. And second would be on the financial ratios with ROCE of 26% plus, ROE of 23% plus, which will be helping this company to sustain in this market. But yes, again, the question comes on the valuation side. Still, I'm not able to get the price valuation what they are expecting right now. But I'm expecting this company to be a very small, under 1,000 crore market cap company, as per my understanding, with the limited data availability. But obviously, the highest OFS will be a biggest concern that will give this company a very risky point at this point of time.
So is it a avoid or subscribe at this time?
I need to wait for the price which will be there declaring. I think tomorrow they will be going to declare that. With that only I can comment more on that. But time being,
Sure.
yes, because of OFS, highest OFS, I will be avoiding at this point of time.
How about Juniper for that matter? Is that a avoid or a subscribe?
Subscribe with risk, I think, because I think the industry is good, the brand is really great in India. There will be limited listing gain. I think around 5 to 10% can be a listing gain, but this company is not for a listing gain candidate. I think it's a long term subscribe, but yes, obviously comes with some risk as of now because of the books which are into losses.
Okay, since we are talking about listing Vibhor Steel Tubes, that's another IPO which is going to be coming up for listing in the next week. It's got a amazing response when it comes to the bidding profile. 20 times subscription essentially was driven by retail investor, which oversubscribed 26 times. Category reserved for HNI also was oversubscribed by 28 times. What are you expecting from Vibhor?
I think the numbers are really more, almost 300 times on the overall size. They were expecting 72 crores and they are getting like almost the highest. I think it's a record breaking demand in the recent times. Obviously, yes, the valuations were cheap at 16 to 18 times PE forward. The segment was really great. The demand is good, and their exclusive contract with JSW Pipes would be the major trigger for the company to go forward. And their expansion plan towards the export market is also helping them. Overall, for me, it was a listing gain candidate, not a long-term call. But if it gets around 90 to 80% listing gain, I am the guy to book profits on the same day.
Okay, all right. Point well made. Okay, I'd also want to defer our topic, or let's just say deviate from the offerings next week and probably put some focus on IRDA stock, which at the start of the week hit the lower circuit limit of 5% for the first two trading session. Sure, there was some bit of recovery, but that also comes on the back of the fact that in the previous session you saw 3 days of lower circuit coming in for IREDA. So there is a fair bit of correction which has already crept into the counter. You think it's a buying opportunity, or how do you look at this largest pure play green financing NBFC right now?
I think for a long-term investor, it's a great opportunity to buy at these levels. The reason behind the fall of 3 4 days back was on the back of results. The overall results looks really good, but there was some kind of dip in the margin, operating margin from 33% to 31%, which markets were not expecting at that point of time. They were expecting the numbers will be going good, margins will be really good, but there was a 200 basis point drop in the operating margins, which triggered the lower circuit for 2 3 days. But end of the day, again, the segment which they are into is a great service, and the way how solar and any other renewable energy is going to expand from next 2 to 3 years, I think it would be a great company to be invested for long term.
Okay. And how about Rishab Instruments? The names seem to be random, but do bear in mind the fact that these names are picked up based on the price action. They are new listed companies. It saw massive wealth erosion. Stock loss as much as 18% for the week post Q3 earnings. I mean, fair bit of sell off which came in for two trading sessions. Sure, some recovery was followed through within the week, but the magnitude was much lower. The company profit slipped 58%. The margin slipped to 8% from 16%. They've maintained the double digit growth. How are you reading into it?
So my reading is very easy on that because at the time of IPO also I was not so much confident on this company. I was knowing this company cannot sustain this 16 15% of EBITDA margin is really difficult for them because of their exposure into the European markets. The way how European market segment has fallen down from almost 50% down from their YOY levels, that has given them a big hit on their margins right now. A single digit margin on EBITDA side and the lower single digit margin on the PAT side is really difficult to understand how this company will be going sustaining going forward. Even at the valuation of 30 PE going forward is very difficult for me to understand why this company is sustaining at these levels. I think if someone is holding this company right now through IPOs or recently, it's a clearly avoid and exit from these levels.
Prashant, actually, we managed to catch up with the management of Rishabh Instruments too. And the company suggested that Q3 is one of the weak quarter that they have. There were a couple of product launches which weighed down on the financial profile of the company. Sure, they suggested that European demand remains to be soft, but they're not really seeing much, negative impact coming in for this one. In fact, they've maintained their top line growth margin of around 20-25%. That's the growth level that they still continue to anticipate. You think you're not confident and you think the numbers will be missed yet again for the quarter?
It was a surprise for each and every investor with the fall of almost single digit margins. So I think we have to wait and watch for the Q4 numbers. If Q4 numbers are really great and as per the management guidance, then only things can work out better on the counter. But time being, I think we have to wait and watch for the counter for Q4 numbers.
Okay, so clearly no solace coming in on that one. But anything that you are picking up, Prashant, within the whole newly listed space, which stands out for you for the week or is expected to do well in the coming week? Anything that really stands out for you?
I think Azad was the great company which did not do well in the listing space. Starting, it was done really great with 30-40% of the listing gain, and then it was very much stagnant in the short term. But I like the management, I like the business model a lot. Today, it's around trading around 1100 rupees per share. I think this could be a great company to invest and a recent new company for long term.
All right, Prashant, we're just going to leave it at that. And thank you for taking out the time and having this conversation right here with us.
Thank you for having me.
All right, viewers, we're trying to change the format of the show. So do write into us. Tell us what do you like, what you don't like, what you want us to include, what you'd want us to change. Also, we're trying to get in more interactive with all of you, understand the queries that you have in your mind, since it's an IPO space which relatively is less covered by most of the analyst community around. We have our experts here who will answer the queries out for you. From next week onwards, we'll have those queries coming up from you, hopefully, and have them answered from the battery of experts that we will line up for you on the show. But that's all that we have in this edition. With this, it's a wrap, and goodbye.